Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. Margin Trading Explained, a complete guide for 2024. Margin trading is a powerful tool that can amplify your trading potential. By borrowing funds to invest, traders can control larger positions with a smaller initial investment. This strategy is popular because of its potential for higher profits. However, it's not without risks. The borrowed money means both profits and losses are magnified. Enter wisely and with caution, as margin trading can lead to significant gains, but also substantial losses. This guide will walk you through the essentials, helping you decide if margin trading is right for you. What is margin trading? Margin trading allows you to borrow money to buy more stocks or assets than you could with just your own funds. This means you can control larger positions and potentially earn higher profits. However, it also means you can face larger losses. Let's break it down further. Basic concept of margin trading. Margin trading involves borrowing funds from a broker to trade assets. This means you can buy more than what your actual account balance would allow. Imagine you have $1,000 but want to buy $2,000 worth of stock. With margin trading, you can borrow the additional $1,000 from your broker. This boosts your buying power and lets you trade larger positions. Key terminology in margin trading. Understanding margin trading involves getting familiar with some key terms. Leverage. This is the ratio of borrowed funds to your own money. For example, if you have $1,000 and borrow another $1,000, your leverage is 2-to-1. Higher leverage means more buying power but also higher risk. Margin call. If the value of your investments drops significantly, your broker may ask you to deposit more money into your account to maintain your positions. This is called a margin call. If you don't meet it, your broker may sell some of your assets. Maintenance margin. This is the minimum amount of equity you must maintain in your margin account. If your account falls below this level, you'll get a margin call. Initial margin. This is the amount you need to deposit before you can start trading on margin. It's usually a percentage of the total trade value. By understanding these terms, you can make more informed decisions about margin trading and manage your risks better. How does margin trading work? Margin trading is a way to amplify your investment potential by borrowing money from your broker to trade more assets than you could with your cash alone. This can significantly increase your profit potential, but also comes with increased risk. Let's break down how you can start margin trading and see an example of how it works in practice. Step-by-step process. To get started with margin trading, follow these steps. Open a margin account. Research brokers. First, find a broker that offers margin trading. Not all brokers provide this feature, and fees can vary. Apply for a margin account. Once you've chosen a broker, you'll need to fill out an application to open a margin account. This often includes agreeing to the terms and conditions and may require a minimum deposit. Initial deposit. Meet the initial margin requirement. You'll need to deposit a percentage of the total trade value. This initial margin is usually 50%, but it can vary by broker. Choose assets to trade. Select stocks or assets. Decide which stocks or other assets you want to trade. Do your research to understand their potential and risks. Check margin requirements. Each asset has its margin requirement. Make sure you have enough funds in your account to meet these requirements. Borrow funds. Request a loan from the broker. Once you've selected your assets, you can request to borrow the additional funds from your broker to make the purchase. Place your trades. Execute the trade. Use the borrowed funds along with your own money to buy your chosen assets. Monitor your positions. Keep an eye on your investments. Prices can change rapidly, and you need to be ready to act if necessary. Example scenario. To understand how margin trading works in a real-world scenario, let's look at an example. Imagine you have $1,000 in your margin account and want to buy $2,000 worth of stock in company XYZ. Here's how it unfolds. Initial purchase. You use your $1,000 and borrow another $1,000 from your broker to buy 100 shares of XYZ at $20 per share. Stock price increases. If the stock price rises to $30 per share, your 100 shares are now worth $3,000. You decide to sell. After repaying the $1,000 you borrowed, you're left with $2,000. Your profit is $1,000 on a $1,000 initial investment, giving you a 100% return. Stock price decreases. If the stock price falls to $10 per share, your 100 shares are now worth $1,000. You'll need to sell to cut your losses. After repaying the $1,000 you borrowed, you're left with nothing. Your loss is $1,000, meaning you've lost your entire initial investment. In both scenarios, the impact on your finances is amplified. This highlights the potential for significant gains, but also the risk of substantial losses. Always manage your risks and make informed decisions when margin trading. Advantages of margin trading. Margin trading offers investors several benefits that can amplify their trading experiences. Leveraging borrowed funds can lead to increased buying power and the potential for higher returns. Increased buying power. Margin trading allows investors to significantly enhance their buying power. This means with the same amount of personal capital, one can acquire more stock or assets. Amplified investment potential. By borrowing from a broker, investors can purchase more than they would normally be able to with their own funds. For instance, if you have $1,000, you might be able to borrow an additional $1,000 to buy $2,000 worth of assets. Better market opportunities. This increased buying power allows investors to take advantage of larger market opportunities. When you spot a promising investment, having the ability to act on it with more capital can be highly advantageous. Diversified portfolio. With more funds at their disposal, investors can diversify their portfolios more effectively. Spreading investments across different assets reduces risk and increases the chances of profitability. This increased buying power can be a game changer, especially in fast-moving markets where timely, decisive action is crucial. Potential for higher returns. One of the most appealing aspects of margin trading is its potential for higher returns. Leveraging positions can magnify profits if trades move in your favor. Exponential gains. When you use borrowed funds to make a successful trade, your returns can be much larger than if you only used your own money. For example, if you invest $1,000 of your own money and borrow another $1,000 and the value of your investment doubles, you've made $2,000 on your initial $1,000, a 200% return. Strategic leverage. Properly leveraging your positions can turn small market movements into significant gains. Traders who are skilled in predicting market trends can use margin to capitalize on these opportunities. Maximized profits. The potential for higher returns is a major attraction of margin trading. It allows investors to maximize their profit potential without needing an extensive amount of initial capital. However, it's critical to remember that while the potential for higher returns is enticing, the risks are equally amplified. It requires careful planning and disciplined risk management to succeed in margin trading. By understanding and utilizing the advantages of increased buying power and the potential for higher returns, investors can make more informed decisions and strategically enhance their trading outcomes. Risks of margin trading. While margin trading can bring significant rewards, it also comes with substantial risks. It's crucial to understand these dangers before deciding to trade on margin. Let's take a closer look at some of the most significant risks you'll encounter. Increased losses. When you trade on margin, your potential losses are magnified. Imagine you've invested $1,000 of your own money and borrowed an additional $1,000. If the value of your investment drops by 50%, you don't just lose 50% of your money, you lose all of your initial investment. Double the stakes. Just as profits can double with leverage, so can losses. For instance, if you borrow $1,000 to buy $2,000 worth of stock and the stock price plummets, you could end up owing more than you originally invested. Full liability. Unlike regular trading where your losses are limited to your own capital, margin trading means you owe the borrowed amount back to your broker, regardless of how your investment performs. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.